It's not uncommon in the world of finance for accountants to encounter challenges related to an evolving discipline for which no accounting standard would have explicitly existed earlier. One example is in this manner how the world of tokens or cryptocurrencies is evolving, as no accounting standard currently exists to explain how this asset class should be accounted. Welcome back to another episode of Facultive Station. Get involved and join the community by subscribing to the channel so you never miss any of our latest uploads. In this episode, we're going to be taking a look at accounting for crypto assets. Let's get into it. In such situations, historically, accountants have had no other alternative but to refer to existing accounting standards and underpinning the rules of accounting related to real, nominal, and personal classification of accounts based on fundamental utility, which the asset is being subjected to, ascertaining the appropriate balance sheet classifications of cryptos, determining if cryptos should be carried at fair value or cost subjected to impairment testing, establishing if gains or losses should be recognized or not recognized at all until sold, selecting the most appropriate price information while valuing this asset class. And in dealing with these questions, we shall primarily be referring to the International Accounting Standard IAS 7 and IAS 32 for balance sheet classification of cryptos, plus IAS 2 and IAS 38 for their evaluation. Before we continue, let's do a short recap on two important concepts. What defines crypto assets and single entity principle in accounting? Crypto assets are intangible digital tokens, which are recorded using distributed ledger infrastructure, referred to as blockchain, providing various rights of use. For example, cryptocurrencies are designed as a medium of exchange use case on distributed ledger. Other digital tokens, e.g. securities tokens, they represent ownership interest, or there could be tokens providing rights to the use of other assets or services. One of the fundamental tenets of accounting is single entity, and a single entity is an operating unit for which financial information is reported. For accounting purpose, a single entity is a separate legal entity compared to an individual or a group of individuals who may own the entity. And therefore, to be able to use an accounting lens on cryptos, it's of utmost importance that we are able to assign an entity relationship to ownership of the tokens, and in doing so, separate out the frameworks which create the assets from the ownership of such asset. We must be able to distinguish the purpose for which the token is being put to use. As we start to discuss on what accounting standards might be used to account for cryptocurrencies, determining the appropriate balance sheet classification of cryptos as per IAS 32 and IAS 7. Is it cash or cash equivalent? At first, it might appear that cryptocurrencies should be accounted as cash or cash equivalents because it is claimed to be a form of digital money. However, cryptocurrencies cannot be considered equivalent to cash as currency because of two underlying reasons as defined under IAS 32 and IAS 7. Referring to IAS 32 for the description of cash, it observes that cash is expected to be readily used as a medium of exchange. However, no crypto asset can be readily exchanged for any good or service, even though one can argue that an increasing number of entities have started accepting digital currencies as payment. However, digital currencies are not yet readily accepted as a medium of exchange as they do not represent legal tender. In other words, entities may decide to or not decide to accept digital currencies as a form of payment, as it is in the case of legal tenders. IAS 7 defines cash equivalents as short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Going by this requirement to be met, cryptocurrencies can be classified as cash equivalents because they are subjected to significant price volatility. Therefore, it does not appear that digital tokens, even cryptocurrencies, represent cash or cash equivalents that can be accounted for in accordance with IAS 7. Or is it a financial asset? Intuitively, it might as well appear that cryptocurrencies could be accounted for as a financial asset at fair value in accordance with IFRS 9. However, it does not seem to meet the definition of a financial instrument either, because it does not represent an equity interest in an entity, or a contract establishing a right or obligation to deliver or receive cash in exchange. In other words, cryptocurrencies are neither a debt security nor an equity instrument, although a digital asset could be in the form of an equity security because it does not represent an ownership interest in an entity. Therefore, it's quite clear that cryptocurrencies should not be accounted for as a financial asset. So, where does it find its place in a balance sheet? Digital currencies, within their current scope, meet the definition of an intangible asset in accordance with IAS 38 standards outlined for intangibles. This standard defines an intangible asset as an identifiable non-monetary asset without physical substance. IAS 38 states that an asset is identifiable if it is separable or arises from contractual or other legal rights. An asset is separable if it is capable of being separated or divided from the entity and sold, transferred, licensed, or exchanged, either individually or together with a related contract, identifiable asset, or liability. Thus, cryptocurrencies meet the definition of an intangible asset in IAS 38, as it is capable of being separated from the holder and sold or transferred individually. Determining whether crypto should be carried at fair value or historical cost, subjected to impairment testing in accordance with IAS 38 or IAS 2. IAS 38 allows intangible assets to be measured at cost or re-evaluation. Using the cost model, intangible assets are measured at cost of acquisition and are subsequently measured at cost less accumulated amortization or impairment losses. Using the re-evaluation model, intangible assets can be carried at a revalued amount if there is an active market for them. In other words, it implies that if there are assets for which there is not an active market, then these assets should be measured using the cost model and not the re-evaluation model. It is unusual for intangible assets to have active markets. However, cryptocurrencies are often traded on an exchange, and therefore, it may be possible to apply re-evaluation model where there is active trading, and that marketplace can be considered as active under IFRS 13, fair value measurement, which defines an active market. However, it's not necessary that if daily trading exists, it is an active marketplace. An active market must also provide the most reliable evidence of fair value. There are two more important implications of IAS 38, as we shall see when we analyze 3 different use cases for holding cryptocurrencies and how they would be treated in the books of accounts. IAS 38 states that a re-evaluation loss should be recognized in P&L. However, a re-evaluation increase should be recognized in P&L to the extent that it reverses a re-evaluation decrease of the same asset that was previously recognized in profit or loss. IAS 38 also prescribes that an entity will need to assess whether the cryptocurrency's useful life in its balance sheet is finite or indefinite, and an intangible asset with an indefinite useful life is not amortized but must be impaired. IAS 2, on the other hand, depending on an entity's business model, allows for cryptocurrencies to be treated as inventories because IAS 2 applies to inventories of intangible assets. It defines inventories as assets held for sale in the ordinary course of business in the form of materials to be consumed in the production process or in their business of rendering services. With that, we've reached the end of today's episode all about accounting for crypto assets. Do any of you guys already own crypto assets? How have you been accounting for them? Get involved and let us know in the comment section down below. If you enjoyed this video, remember to leave a thumbs up. Plus, if you want to see more fantastic finance and accounting content just like this, remember to subscribe to the channel and check out our other socials such as Instagram and TikTok that are listed in the video description. Also, if you want to know more about accounting and are interested in the world of finance, check out the link to our very own course also in the video description. As always, thanks for stopping by and watching. See you again soon in the next one.